Good evening, everyone. Hope you all are doing well. So, today we are going to discuss question number one of this September December 23. This is day one of September December 23. Today we will solve question number one, Hammer Group. We all know question number one include four parts and the marks for question number one is 50 marks. Part A mostly come for the business risk, part B for the audit risk or risk of material misstatement, part C on audit procedures, and part D from any topic of block 1 or block 2. Mostly part D come for the ethics and matters to be considered. In this question, we will learn about the part D. Okay, first read the requirements. Respond to the instructions in the email from the audit engagement partner. Note, the split of the mark allocation is shown in Exhibit 1 partner's email. Professional marks will be awarded for the demonstration of skill in communication, analysis, and evaluation, professional skepticism and judgment, and commercial acumen in your answer. Previously, we have solved two past paper questions, complete questions, question 1, 2, 3 for December 22 and question 1, 2, 3 for March, June 22. So all these past paper lectures are uploaded on the ACCA Passpoint channel, and the playlist is topic wise past papers in which you can watch the previous recordings. So let's read the question. It is 1st July 2005. You are a manager in the audit department of Stanley Associates, a firm of chartered certified accountants responsible for the audit of the Hammer Group. This is the client Hammer Group, the group for the year ending 30th September 2005. The group, which is not a listed company, highlight this thing that this client is not a listed company, operates a number of hardware stores which supply trade customers and the public. Your firm audits all components of the group means we are not only responsible for the group audit as well as for all the subsidiaries. Your firm audits all the components of the group, including a foreign subsidiary acquired during the year. The following exhibits available on the left-hand side of the screen provide information relevant to the question. So first exhibit is partner's email in which we identify the threshold of materiality and other questions. Also, exhibit 2, 3, 4, and 5 we will use for parts answers. Let's read the exhibit number 1, partner's email. So, we all know in question number 1 we have to write a briefing note, and the structure of the briefing note is discussed in my previous past paper lectures. So for the complete structure you have to go through these notes or the lectures. Again, I am preparing a briefing note structure in this question because without briefing note structure we can't solve this question. As I have mentioned so many times that for the briefing note, the to become from and from become to. So to from subject date to audit manager means this is for us. But once we write our answer, so of course we will have to write a briefing note to the engagement partner. So in that case, from become to and to become from. To audit manager from Paula Sanders Group Engagement Partner. Subject Hammer Group Audit Planning. Date 1st July 2005. Hello, I met with Group Finance Director yesterday along with representatives from the Group Audit Committee. We discussed the group's activities during the year and its plan to expand into further international markets next year. Highlight this thing. They also provided with some extract from the projected consolidated financial statements and a selection of key performance indicators KPIs. I have also provided you with some background information about the group to assist with planning the audit. Okay. Based on the analysis which I have done on this industry, it is appropriate for overall materiality to be based on revenue. Now it's mentioned or it's told by the partner that we should have to use revenue as a materiality. You will need to determine and apply an appropriate materiality threshold in your briefing notes. We all know the thresholds for the revenue in case of materiality is 0.5% at lower end and 1% at the upper end. It's all based on our judgment. Either we should use 0.5% or 1%. Using the information below, I require you to prepare briefing notes for my use in which you, Part A, evaluate the business risk faced by the group. Part B, evaluate and prioritize. Even the examiner mention or not, we have to prioritize the risk of material misstatement based on the materiality amount. Also, evaluate means we have to give the conclusion. It's important only in case of business risk, sorry, in case of audit risk or risk of material misstatement. Evaluate and prioritize the risk of material misstatement to be considered in planning the audit of the group. Note, you should refer to exhibits 2, 3, and 4 when carrying out the requested risk evaluation. Part C. Using Exhibit 4, design the principal audit procedures to be performed in respect of the expenditure relating to the store enhancement program. So for the Part C, we have to write procedures. Part D. Using Exhibit 5, discuss any ethical issues arising and recommend any actions which need to be taken. If you read, there is a note, you should refer to exhibit 2 and 2, 3, and 4. So it means we don't have to write any risk for part A or B from exhibit 5. If there is a note, then we should have to follow this because it will help us in achieving a communication mark. Now we are done with the partner's email. Let's read the exhibit number 2 and identify the business risk as well as risk of material misstatement. Okay, what is going on? I think I should. Okay. So, Exhibit 2, the group operates a number of large hardware stores within the domestic market. The stores supply building materials and equipment to the public and to builders. The Hammer brand, which is internally generated, highlight this thing as it will help us in writing a risk of material misstatement as it is an IAS 38. Intangible asset is internally generated and not recognized in the consolidated statement of financial position is key to the group's success. One of the group's subsidiary Wrench Company is a financial services company specializing in providing savings accounts and loans to individuals. Now, point number one, Mallet Company is a wholly owned subsidiary and operates the Hammer stores. It generates the majority of the group's income. Mallet Company owns 50 retail stores across the country. Mallet Company has been involved in a price war with another national hardware store during the year, offering significant discounts and heavily marketing the Hammer brand is in an attempt to increase market share. Now, what do you think? If any business is spending so much on the marketing, don't you think it will affect their expenses? Means profitability will be affected as they will have to increase the major amount on the marketing. So, what do you think? If any company spend too much on the marketing, don't you think it will affect their profitability? We will cover this thing or we will link this thing with the financial figures. Also, if any company is offering significant discount, don't you think once they stop giving the discount, it will lose their customer power because customer will not come to them. If, why? Customer will think that we are not going to receive any discount, so it's not that we should continue with the Mallet company or the Hammer group. So these are the indicators which affect the business cash flow, profitability, market share. even though it's mentioned that marketing the hammer brand in an attempt to increase market share. No, this is not correct. Okay, so ladder company. Ladder company is an overseas subsidiary in Farland. We have studied in block 1 significant subsidiary. If a subsidiary which is a foreign subsidiary or covering 15% group total assets, total revenue or profit, then it will be considered as a significant subsidiary. So Ladder Company is an overseas subsidiary situated in Farland. The group obtained a 65% shareholding in October 2004 for cash consideration of 82 million. The share purchase was financed partially using a 32 million bank loan with a variable interest rate which was taken out in October 2004 and partially through group's existing cash reserves. The bank loan has covenants attached to it in relation to interest cover gearing. This is an important line for the business risk and the risk of material misstatement. We know whenever any covenants attach with the loan, there is a possibility of breach of covenants, and if covenants breach, then the bank may demand immediate repayment of the loan. This will affect the liquidity positions of the company, which may cast doubt on the group's ability to continue as going concern. The purpose of the acquisition was to expand the group's operations into a new geographical market. This is the first overseas investment made by the Amar Group. This is the first overseas investment. There are certain rules and regulations which Amar Group may have to follow. What if they may not comply with those rules? So it will result in a loss of investment. Ladder Company owns 50 hardware stores in Farland. The 35% non-controlling interest NCI in Ladder is owned by the government of Farland. The NCI is a government. This is a separate point. Okay, you have to highlight this one as well. By the government of Farland due to a regulatory requirement that at least that portion of a company's share capital is government owned. The currency in Farland is the same as the country in which the group is based, means no difference in the currency. Your firm was appointed as auditor of Ladder Company in October 2004, and several members of the audit team have traveled to Farland to become familiar with the company, its key management personnel, and its regulatory environment. Farland does not mandate the use of IFRS. Of course, this is not a big deal. And Ladder Company's individual financial statements are preparing using Farland's national accounting standards. But once we are preparing the consolidated, so we have to ensure that for the consolidation purpose, the Ladder Company's financial statement should be as per the IFRS. Branch Company is the financial services company of the group operating the Amar Bank. Its customers are mostly trade customers who obtain credit and loans to finance long-term building projects. In the last year, the financial services regulator has been investigating many banks for charging excessive fees to customers in relation to loans, meaning that customer can claim back the excessive fee they have been charged. Ranch Company has received legal claims from more than 25,000 customers. This is an alarming situation. In respect of this, and the group recognized a provision of 22 million in its statement of financial position. There is a possibility that the provision might be more about this 22 million. So we have to be skeptical as well. Now move to the exhibit 3, financial information, in which we link all the financial figures. Okay. Extracts from the projected consolidated FS, including notes for the year ending 30th September 2005, and comparative information are included below. 30th September 2005 and 2004. So previously in 2004 we have a revenue of 402. Now we have a revenue of 450 million. Operating profit before exceptional items. What are the exceptional items? We will cover in the note 1. It was 78, now it is 97. Operating profit after exceptional items 30 to 30 from 30 to 32. Finance cost 5 to 8. Profit before tax from 25 to 24 means there is a 1 million loss. Total assets 463 to 500. There is a capital expenditure. Including in total assets, inventories note to 72 to 75 means we are bleeding our cash. Note 1. Exceptional items are those determined by management to be non-recurring. Non-recurring means one-off. In 2000, X5 exceptional items relate solely to store enhancement costs. More detail is provided in Exhibit 4. The exceptional items in the prior year were audited in 2000 X4 and no exceptions were noted. Even though it has been audited in the last year, but still, as an auditor, as our professional liability or responsibility, we will have to work on it. The executive directors each earn an annual bonus which is based on annual increases in profit before exceptional items. Don't you think there is a chance of manipulation as their bonuses are linked with it? Note number 2. Inventories include materials such as painting and decorating materials, timber and doors, as well as tools and equipment for use by professional builders and customers planning to improve their homes, do it yourself or DIY customers. Inventories are measured in accordance with IAS2. The group operates a stock take once a year on 30th September in their store. KPIs gearing 35 to 68. Oh my god, this is so big. There is a huge difference. Current ratio 1.4 to 1.1, interest cover 6 to 4. It is decreasing. Now, move to the exhibit number 4. This is the last exhibit with respect to part A, B, and C. Store Enhancement Program. In Feb 2005, the group started a program of extending and renovating all 25 Mallet Company's larger hardware stores, which will become destination stores and each will have a cafe or restaurant. The program is expected to cost 5.75 million per store. We will have to ask the breakup of this cost. At any one time, 5 stores are closed while the renovation and necessary construction work takes place. Also, we will have to ensure whether any revenue item might not be misclassified as a capital item. And on average, a store will be closed for 2 months while the work is carried out. The group considers this program to be extremely important to strengthening the brand and maintaining market share. The cost relating to the store enhancements included in the statement of profit or loss, okay, which are projected to total 65 million by the financial year and will be separately disclosed as an exceptional item in the group statement of profit and loss. In addition to the 65 million included in the SOPL, 55 million will be capitalized within property, plant, and equipment by the financial year and including expenditure, extending car parking facilities, construction new facilities, redecorating the stores, exteriors and interiors, purchase and installation labor cost, including some of the group own employees. We will have to write a point that why personal employees cost are capitalized. This is not a valid point. Sales promotions. In response to the actions of a major competitor, the group introduced several sales promotions during the year. Again, it will affect our profitability. The promotions include heavily discounted product lines and buy one get one free offers mainly apply to the group's paint and wallpaper lines. So that's it for part A, B, and C. For the part B, we will move to exhibit 5, but first solve part A, B, and C. Make sure you have all this information in your head. Also, you should download or open this question on your CBE platform because once I start solving this question, Once we move to the answer slides, I will not move back to the question. Make sure you open these questions on your CB platform or it should be downloaded in your device. Even though I will try to link each answer or each risk with these exhibit, but we are humans, we can make mistakes. So that's why it's important that you should have opened this question. Okay. Emmer Group September December 23 question number 1. There are few important points which I have mentioned all the past paper questions. Now we have professional marks. I have covered so many times. So this is for your personal reading. Okay, this is the briefing note structure. As I mentioned, from become to, now you can see the two is from in the exhibit 1. So two Paula Sanders from audit manager, subject Amar Group, date 1st July 2005. Introduction. This briefing note is to evaluate the significant business risk which Amar Group faces and the significant risk of material misstatement in planning of audit, design the principal audit procedures and ethical issues arising along with the recommended actions. Significant business risk. Price war. Remember, there is a price war. So I just pick this word and make it a heading. Mallet Company, wholly owned subsidiary of Hammer Group, has been involved in a price war with another national hardware store during the year, offering significant discount. This results in loss of potential customers in the longer term, as for now they are associated with Mallet Company just because of heavy discounts, as the revenue increased by 11.9%. This year also incorporates the revenue of group's paints and wallpaper, which were on sales promotion. Remember last para of the fourth exhibit, how I link different information into one risk. Were on sales promotion discount, and once the discount policy ends, customer will shift towards another supplier. This is the ground reality. If you have been involved in any business and if you were offering any discounts or any promotional services, you have the idea that once you stop offering such services, those customers who were just with you based on such discounts or services will not be with you once you stop giving or providing benefits. So this is given and take rule. Now, overseas investment. Remember, this is the one or the first overseas investment. Led company is an overseas subsidiary situated in far land, and this is the first overseas investment made by the Amar Group. As Amar company has no previous knowledge of an overseas investment, due to which there is a risk of management cultural issues and political stability, which may affect Amar Group operations in case of non-compliance, which may result in a penalties or fines. Also, due to government regulations, failure will result in loss of Hammer Company investment in overseas. In the business race, major or most of the student did same mistake. And what are those mistakes? Most of the students try to link their business risk with the profitability, with the cost, with the revenue. Their business risk, each business risk will around these three factors. No, this is not a valid business risk. For a valid business risk, you have to cover all the aspects of the business: revenue, profitability, marketing share, reputation, brand image, customer relationship, loyalty program, everything. I have write down the complete business risk indicators and the scenarios on my blog 3 lecture of business risk, which you can get on ACCA Passpoint channel. So it's highly recommend you that you should go to the past paper slides and try to use those notes or lectures for your better or clear understanding. Okay, so now we have store enhancement. Okay, now we have store enhancement program business risk. In Feb 2005, the group started a program of extending and renovating all 25 Mallet companies' larger hardware stores, and 5 stores are closed while the renovation and necessary construction work takes place. Okay, there is an important note for you. Whenever examiner gives you 2 to 3 exhibits, make sure also if the examiner mentioned that you should have to follow these exhibits. So your business risk, audit risk, or ROMM should be from each of the exhibits which the examiner mentioned. You can't do this that you selected 4 to 5 businesses from one exhibit and then you left second exhibit for the audit risk or ROMM. Make sure you cover all the exhibit for each of the risk. Otherwise, you will lose your professional marks. Okay. Duration of closed operations for an average of 2 months results in a significant loss of revenue, as the customers may shift towards the competitor stores and in future will not return once the refurbishment done. Also, there is a risk of breach of loan covenant if the refurbishment cost exceeds the budgeted cost, and for that group may have to obtain further finance from the bank as the gearing and interest cover ratio this year is negative, which may result in a difficulty for the group to obtain further finance. Heavy marketing. Mallet company heavily marketing the Hammer brand in an attempt to increase market share. This results in a reduction of profit as the heavy marketing cost increases the expenditure for Amer Group by bleeding the significant cash outflows. As it can be seen from the projected financials that the profit before tax this year is reduced by 4%, even though there are other factors too. Look how I included a reduced percentage of PBT in this risk. Legal claims. Wrench Company has received legal claims from more than 25,000 customers in respect of charging excessive fees to customers in relation to loans. This can result in a negative reputation to the Amer Group and a potential loss of customers, which significantly impact the Amer Group financial services operations. Now we are done with the business risk. Let's solve the significant risk of material misstatement. We should start with the materiality. Always start with the materiality for ROMM and audit risk. It's mentioned by the engagement partner that we should have to use the revenue for materiality. As per the engagement partner, materiality should be determined based on revenue, which have a threshold of 0.5% to 1%. Based on 0.5%, the lower end of the materiality is 2.25 million, as 0.5% multiply by $450 million, whereas the upper end of the materiality is 4.5%. Once you are done with this calculation, then you should have to pick your materiality threshold. For that, you have to give a logical reasoning. As this materiality is set at the planning stage and Emmer Group is not a listed entity and is a recurring client, means existing client of Stanley Associates. Considering the proposed restructuring means development and the increased pressure on the company's profit margin in the air increases the level of risk. Therefore, the materiality should be set at lower end, which is 0.5%. This one. Okay, this is all on your judgment. So if you are choosing the lower end, you have to give a valid justification, or if you are using a upper end, then also you have to give a logical reasoning. Now, renovation and extension program. If you remember, in the requirement of part B, I mentioned that you should have to prioritize their risk based on the materiality amount. Now, in these questions, you will get the idea. Look, the amount, the cost is 140 million. It's material as it is above the amount of materiality. If you, sorry, okay, if you check this risk number 2, the amount is 97 million, which is less than 140 million. So I prioritize this risk as risk number 2, and risk number 3 will be less than risk number 2. Let me search, is there any amount or not? Okay, no, there is no amount. But there are some judgments based on that I write down as risk number 3. You just have to prioritize one or two risks. That's it. Let's solve this one. Renovation and extension program. Store enhancement cost 140 million, 143 million is material to the financial statement as it exceeds the amount of materiality 2.25 million. There is a risk of incorrect capitalization cost as the capital expenditure and revenue expenditures may not be allocated properly appropriately, due to which property, plant and equipment PPE and expenses may be over or understated. Renovating costs such as redecorating should be expensed out, whereas cost of car parking, installation, and construction should be capitalized, as it is possible that management may misclassify operating costs as capitalized in nature to increase the reported profit. As the multiple assets are capitalized during the year and all the assets have different useful life, as useful life involves subjectivity and judgments, there is a risk that inadequate useful life has been used for the depreciation of the items from the start of the store's operations, due to which non-current assets and depreciation expense has been over or understated. Exceptional items. Amount of exceptional items in relation to store 97 million is material to the financial statement. Exceptional items includes additional performance measurement which presents on the face of P&L for users better understanding. Exceptional items, non-recurring items should be present on the face of P&L for the better understanding of the stakeholders. It is based on the management's judgments and estimates as which items are exceptional. There is a possibility that management may incorrectly present the exceptional item as it involves subjectivity, due to which operating profits being overstated. Also, there is a risk of management bias as directors' bonus based on operating profits before exceptional items. So far, this management manipulates the financial figures for better bonus. Acquisition of ladder company. The cost paid for an acquisition of ladder company is material amount. At the date of acquisition, all the assets and liabilities are recorded at fair value. Remember, some paid in the partial finance and through the group reserves. Also, there is a cash consideration. As per IFRS 3 business combination, fair value is a complex and subjective matter as it involves judgment and estimates. So, there is a risk that the fair value at the acquisition date of the net assets is not recorded correctly, as not all the assets and liabilities are measured appropriately. Considering ladder company is a foreign subsidiary and identification of net assets is complex. Failure to recognize all the net assets result in a misstatement and will negatively impact the goodwill, due to which non-current assets could be over or understated. As Stanley Associates appointed for the first time of the auditor of ladder company, there is a risk of opening balances as opening balances may not be correctly brought forward. Inventory valuation. Amount of inventory 75 million is material to the financial statement as it exceeds the materiality level 2.25 million. As per IAS 2, inventory shall be measured at lower of cost or NRV. As the audit risk or risk of material questions, there is a structure. First, you have to compare the materiality amount with the misstatement amount. After that, you have to write a accounting treatment. After that, you will have to write a issue, the risk, and its impact. Now, in inventory valuation due to sales promotion which group introduced by the deal name of buy one get one free. This sales promotion reduces the NRV amount of inventory below cost. Based on this, NRV loss may not be recorded by the management, which results in an overvaluation of inventory. There is a possibility that due to management bonus based on operating profit, level of inventory is high as it will increase the operating profit and ultimately hit the bonus. Now, provision for legal case. As one risk of material misstatement and audit risk cover 3 marks if there is a materiality paragraph or materiality line. Without materiality means without financial figures, the risk will give you 2 marks. So make sure marking scheme should be allocated properly. Provision for legal claim 22 million is material to the financial statement. There is a risk that not all the provisions regarding claim have been recognized or the measurement of the provision is not correct as the claim for excessive fees is ongoing due to which liabilities may be understated and profit may be overstated. Also, there are high fine and penalties imposed by the finance regulators over dispute and there is a risk that it has not been recognized as a provision and again liabilities understated and profits overstated. Legal costs associated with the claim should be recognized as accrued. Failure to record legal cost results in understatement of liabilities and expenditure. As IAS 37, provision contingent liabilities and contingent assets require disclosures including a briefing description of the nature, timing, assumptions, and uncertainties related to the amount recognized. There is a risk of inadequate disclosures in notes to the financial statement. Government as NCI. The 35% non-controlling interest in ladder company is owned by the management of Farland due to a regulatory requirement that proportion of a company's share capital is government owned. As per IFRS 10, consolidated statement of financial position controls some come at 50% when the acquirer has the power over acquiree or exposure or rights to variable returns from its involvement and the ability to use its power. Now you guys can just cover your head and start to think how should we write these lines. You can only write these lines when you have little knowledge of SBR standards because risk question, audit risk ROMM questions, and question number 3 matters to be considered at the completion stage will only be solved if you have SPR knowledge. For that, I have also uploaded a complete playlist on SBR, IAS, and IFRS. So you guys can continue or watch their lectures as well. According to such factors, classification of ladder company in group financial statement as a subsidiary is correct. However, 35% shares by government as NCI can give controlling power to the government over ladder company as it's the first investment by Emmer company and there are regulatory requirements of share capital. Therefore, there is a risk of material misstatement. Consolidated financial statement as or as ladder company is not subsidiary of Emmer Group. Farland National Accounting Standards and conclusion. Let's read the conclusion. Business risk has been prioritized based on loss of customers once discount policy ends and loss of return on overseas investment. Now you do not need to prioritize business risk, just prioritize the audit risk. So ignore this line. Okay. Just prioritize and you have to write a conclusion based on the audit risk and risk of material misstatement, not for the business risk. So this is for the conclusion. Now part C, audit procedures on store enhancement program. Remember exhibit number 4. Let's read the procedures. Review the forecast budget to ensure that the expected cost 5.75 million per store is correct for the extension and renovation of the stores. Review the logbook of the operations to confirm that the specific stores were closed during the renovation process. Physically inspect sample of stores to confirm the existence of their renovation at year end. Select sample of cost 55 million, capitalize and agree with supporting documentation such as materials, cement, brick, fittings to supplier invoice, labor cost to approve payroll record, timesheet maintained by HR department, overheads to relevant evidence if any. Discuss with management the policy for capitalization of cost to confirm that appropriate amount of 5.75 million is capitalized. Review the list of amount capitalized. Remember the parking facility, the installation, to ensure that revenue items have not been capitalized as per policy. Compare budgeted cost per store with actual cost and investigate significant differences, means variance, to confirm that the variance amount should be correctly classified. Review experts' assessment of stage of completion or completion certificate to confirm the updated status of the renovation. Obtain list of authorized vendors, supplier from whom the items were purchased to confirm that the price are accurate. Review fixed asset register, if any, to confirm that the depreciation charge when stores start operations. Also recalculate the depreciation amount to confirm that accurate depreciation has been charged using adjusted useful life of each asset. So this is for part C as well. Now we will solve part D. If you get the idea that all the above part A, B, C are same from the previous question, there is nothing new, nothing changed. Same risk, audit risk, business risk, ROMM, same procedures. You just need a mindset. You just have to follow the standard wording. You just have to follow the standard structure. It's nothing new, it's nothing difficult. If you follow my lectures and my past paper videos, then I can I can give you a guarantee that no one can stop you from passing this exam. Students usually failed in this exam just because this exam is completely different from other P-level exams. In this exam, your drafting, your linking is most important. It's all about the drafting and linking. So, drafting and linking is an art which you only can learn if you follow the pattern, the structure, and try to solve these questions on your own. Because if you just watch these past paper videos and their material which you read on the drive, it will not help you. Please make sure you guys watching these lectures and practice on your own on CBE platform. So, I have mentioned so many times whenever examiner asks you for the procedures, use this approach. CASP, for case, specific, A for action, S for source, P for purpose. If you compare my procedures with this structure, all the procedures will be revolved around CASP. Okay, let's read the part D, exhibit 5 for part D. Additional services. Okay. The group, while not listed, follows best practice corporate governance principles by having an effective internal audit department, which reports to an audit committee of independent non-executive directors. Investment advice, a consolidation adjustment. The group is now considering further international investments in the next few years. Remember, 1 point for 1 mark. And the group audit committee has asked your firm to provide advice on the selection of target companies and the financing of any investments which take place. A fee has been proposed for providing this service amounting to 75% of the audit fee, self-interest threat, and advocacy threat. Consolidation adjustment, as the group finance director does not have the expertise to complete the conversion from far land accounting standards to IFRS. Accounting standard competency issue. Your firm has been approached for assistance in this matter. Assistance means self-review and familiarity threat, for that you have to follow the block 2 lectures, ethical and professional issues. They have requested that as part of the audit, your firm makes the necessary adjustment to apply IFRS accounting standards to ladder company's financial statement and then to consolidate the group financial statement. Let's move to the answer slide. Group Audit Committee has asked your firm to provide advice on the selection of target companies and the financing of any investment which take place. This results in an advocacy thread as audit team members work for the best interest of Amber Group by providing advice on investment, and self-review thread as audit team may be reluctant to review the investment while performing the audit. Providing managerial level services to an audit client results in objectivity thread and familiarity thread as audit team member may be sympathetic towards the client. A fee has been proposed for providing this service amounting to 75% of the audit fee. This results in a self-interest threat as 75% audit fee based on providing this service, which influence auditors' financial interest. Also, it is a contingent fee which is not allowed for both the services assurance and non-assurance. Fee should be based on required time and experience to complete the work actions. In order to reduce the impact of such threats, Stanley Associates should measure the following safeguards. Obtain written agreement from the management that they are responsible for the decision making regarding planning international expansion and associates finance. Independent team members should be appointed to perform the audit and investment advice. Now, this is your assignment. You have to follow these two paragraphs. So that's it for question number 1. This is day 1 of September December 23. Question number 1, Emmer Group. We will solve question number 2 tomorrow, and day after tomorrow we will solve question number 3. Take care, goodbye, and best wishes for your exam.